Hello and welcome, everybody. I'm Vern Cushenberry, Chief Investment Officer, and I'm back with another quarterly update. Going to take a deep dive into the data. I want to talk a little bit about how the economy's doing, hit interest rates, hit inflation, some of the hot topics on all investors' mind. But bottom line up front, these conversations focus on retirement. That's our specialty. And the formula for successful retirement outcomes doesn't change quarter to quarter, doesn't change month to month, it doesn't change day to day. By and large, what we discuss in these quarterly videos falls underneath the broad category of normal volatility, and it's important that we take these things in stride. And I see nothing this quarter that would cause us to deviate from that stay the course, tried and true wisdom. So if that's what you needed to hear, you have my permission to go ahead and check out for the quarter. I'll be back again with another quarterly video in 3 months. This quarter was a good one for stock markets. Stock market was up 8%, international up 3%, and then bonds were about flat on the quarter. If we look at a broader picture here, you can see what happened in the last year. Equity markets have broadly rebounded from the pullback that was COVID. In the wake of COVID, you can see domestic stocks up 19, international stocks up 17, but even the bond market in the last year has been roughly flat between US and global. And if you pan out 5 years, we're still getting positive returns in the bond market and 11% returns in the US stock or in the global markets. This is our focus. Let's look at inflation. Everybody feels it. Inflation is everywhere. You can see here from this chart that it peaked out close to 9% last year and has rebounded significantly, which is good news from the standpoint of the Federal Reserve and policymakers. They have been very aggressive with their interest rate rising cycle. That's the primary tool used to fight inflation. And you can see that on this next chart here. This is the Federal Reserve's response to those rising inflation numbers. They have embarked on one of the most aggressive interest rate rising cycles of certainly my career, now over 5%. So that's another point I wanted to be sure and mention this quarter was we were talking with a lot of investors about the return they're getting on their cash accounts. Historically, cash was yielding near zero. Well, that's not the case anymore. We now have money market funds that are returning 4.5%, 5% for investors. So if you have cash sitting on the sidelines, or you have an emergency fund that serves that purpose for your portfolio, now's the time to be reconsidering the yield on that. From the economy's perspective, we continue to move along. Positive GDP, wage growth is strong, the economy's growing, and I cherry-picked this chart this quarter because I think it tells part of that story, which is personal savings rate. The economy is 60 to 70% based on consumer spending, and the amount of savings has a big influence on that. And you can see personal savings spiked here just after 2020 with the stimulus measures. That made it into the bank accounts of a lot of individual investors. And then if you look at this blue dome, you can see kind of the spend down of those savings. So the peak excess savings maxed out at 2.1 trillion. And then in the last 18 months or so, you can see those peak savings numbers decline significantly. So I think of that as dry powder, so to speak, that's being used as fuel for the economy. Those resources are being and have been exhausted to some extent over the last 18 months. Those won't be there in the next 18 months unless we take on more debt as individuals. So that's something we're being mindful of. We need to see another driver of economic growth inside the next 12 to 18 months, or we may risk seeing a recession. And again, we're not afraid of recessions. They're a normal part of a healthy economy. The economy ebbs and flows. We know what that feels like, what that sounds like, how to manage that through it. We've stress tested most of the portfolios for our individual investors. And if you feel like you're experiencing a little bit of anxiety about what that might look like, be sure you schedule an appointment with your financial planner and we'll stress test that again for you. Okay, moving on here. Let's talk a little bit about banks and real estate. I've touched on both of these topics in the last 2 quarters. We had several bank failures in the first quarter. I did a video on that last quarter, and I talked a little bit about commercial real estate. Well, this is another perspective on that same issue here that I pulled this quarter because I wanted to share it with everybody that's tuning in. And you can see here that, let me start down here with bank deposits by bank size. The blue is small banks and the gray is large banks. So you can see large banks, well, they're a little bit better capitalized, you might say. Smaller banks, you can see their deposit growth over the last few years. This is the data point that I'm really focused on, which is commercial real estate. You know, as we just renewed our lease, and I'm observing what I think many landlords and tenants are observing across the country right now, which is lease rates are a little weak, and a lot of concessions are being made to keep the vacancy rate from spiking too much further. And 44% of those commercial real estate loans are held by small banks. So if that is a source of stress in the economy, we expect it to hit small banks. So that's just something else that we're being mindful of. I'm not ringing any alarm bells here. I'm just noticing that the large majority of those commercial real estate loans are held by small banks. We did have some small bank distress earlier in the year, and if that manifests with defaults or further price concessions, that's something else that could be a source of stress in the economy. Here's another view on that. I mentioned that landlords have been having to make concessions. Well, that shows up in something called cap rate. You can think of cap rate as kind of like a return on investment for the real estate industry. And that return has fallen significantly as landlords have made those pricing concessions. Some of the other investments that they've had to make to renew those leases. And that's all in an effort to maintain vacancy rates at an acceptable number. And you can see here, office is in gray. The office vacancy rates have spiked significantly over the last 12 months. But again, there are no alarm bells going off here. We've seen these rates in the past, and we know how to manage through that type of scenario in the economy. So this is federal debt. I'm looking at federal finances here, and I measure federal finances in terms of total debt relative to the size of our economy. And we measure the size of our economy in GDP. So we look at total debt relative to GDP. And that's down here in the bottom right. You can see total debt to GDP spiked after World War II. And then we haven't seen those rates since, really. We are just now edging up on what would be the maximum total debt to GDP number that we've seen in 60 years, 70 years, at about 100% of GDP. And the CBO, the Congressional Budget Office, well, they take a look at our deficit spending and Social Security and other entitlement programs, and they forecast that into the future. And right now, that's forecast to rise significantly in the next decade. Okay, well, that's going to be a drag on the economy if we don't make some changes. What could those changes be? Well, we can spend less. We can cut benefits to our entitlement programs. We can tax more, raise money at the federal level, but the taxing more is another drag on the economy. So there's a lot of levers that we can pull. It's going to be a challenge to manage through this in the future, and it's something that fascinates me on the geopolitical level. And I like to watch these charts at least quarterly. Okay, let me wrap it up. I always try to wrap up these videos with some timeless wisdom, and this is a good chart to remind everybody about the power of diversification. Our goal is never to be Well, if you look at this chart, what you see here is the top performing asset class in each year and the bottom performing asset class in each year, and rank ordered from top to bottom. So our goal is, never to be first and never to be last, and that broadly diversified portfolio is tracked here in what we call an asset allocation strategy. And the power of that over time has been very effective at creating positive retirement outcomes for our clients. Okay, and then lastly here, we measure the attractiveness of any single market relative to where it has traded historically. So I thought I'd throw this chart in this quarter just so that we can see, if we look at US Treasuries, well, the yield on US Treasuries now would suggest that's approximately, this chart shows -1 as -1 standard deviation away from its historical mean. That means that it's cheaper than what it has been historically, which means that from an investment standpoint, relatively more attractive. And then these asset classes are ranked from cheapest to most expensive, and you can see relative to their historical means. We have bonds across the board, emerging market equities, developed market equities outside of the United States, global bonds, and then we start to get a little bit pricier as we get into US growth. So how do we factor this into our investing? Well, we ever so tactically and subtly shift our exposures towards the cheaper asset classes on this chart. And by being deliberate about the way we do that over time, we feel like we have the the full weight and force of academic literature at our back to create some tailwinds over time. So that's my update this quarter. Thanks for your time. I really appreciate it. Appreciate everybody tuning in, and give me some feedback, and I will be back again in another quarter with an update.